Welcome, everyone, to Name Confidential Live.
Hey guys, welcome back to another episode. I am one of your hosts here at NAAIM, Branden DuCharme, and today I have the great pleasure of being joined by a Wall Street giant here, Jay Hatfield, from uh, uh, InfraCap. Sorry, I'm going to butcher that. Um, and what a wild week once again. Markets finally take a breather after a huge run in recovery, V-shape as V-shape gets. And the name exposure index this week comes back at, 94. So as a demographic from a sentiment perspective, active managers they're long, right? Not max long, they're not leveraged, but they are long, and that tends to get closer up to the extreme of where active managers as a whole tend to get, right? So it looks like it's moving along, but there's also some momentum divergence, and there is a lot going on in the macro environment. And I'm really interested and excited today to hear from Jay about his thoughts of what's going on in the macro environment. I know, Jay, you just mentioned to me that Waller was talking today, and you had some thoughts on that. Give us your insights. What do you think's going on in this crazy world we're living in right now?
Thanks, Brandon. It's great to be on. And we do always like talking about macro. And we always, though, urge everyone to focus on the facts and not the opinions. We were before we got on, trashing a few pundits who are all opinions and no facts. So we have two independent variables we look at to predict inflation. It's also called exogenous if you took economics variables, but so coming from outside the system and affecting the system, it's monetary policy and oil prices. So we had a completely non-consensus view that these tariffs were going to have no impact, net impact, because the dramatic decline in oil was down 20% at one point, offset the potential impact from tariffs, which we thought was going to be muted anyway. So, and the money supply is shrinking year over year. That's extremely tight. So if you hear anybody at the Fed say, oh, we're not that tight, they're just flat out wrong. And you can also tell the equilibrium Fed funds rate somewhere between 2.75 and 3, and even the SEP or their forecasts say that. So the problem with the current Fed is they don't follow our model. So that's important to keep in mind. And so we think we're in a deflation going well below 2. They don't, because they focus on the Phillips curve. So that's employment and how close to full employment we are. And we're pretty close. So they're worried about that. And they're worried about the expectations theory of inflation, which we think is 100% discredited. It implies that if someone believes there's going to be inflation, they can somehow create inflation. But that's only true when you have market power. When you don't have unions, when you don't have market power and corporations, you can't do that. But they don't care. I mean, this is an unexamined belief. So they're worried that the tariffs create inflationary expectations and inflation spirals out of control. We're not.
Is that the idea of like unanchored inflation when people talk about unanchored inflation?
Right.
The belief that we can raise prices because people are expecting us to raise prices, and
Right.
because we raise prices, they demand more wages, and because they get paid more, we can raise prices more, and that unanchored cycle. Okay, all right.
And where that really came from was the 70s, because none of the models that anyone used could explain the inflation. So they had to kind of come up with that notion. But they also didn't realize that the energy prices bleed into core. In other words, it's not just when you directly consume energy as a consumer, right? That's 6% of CPI. But every good has an energy component in it. Like food is like 40% energy. So oil prices were up a horrendous 1,200% in the 70s, which is almost unimaginable. It's like oil going over $1,000 a barrel from 70 right now. So that's what caused the inflation. And then this notion, though, they tried to explain it because they didn't understand that oil was that important. Also, there was just high money growth too. But so expectations in our models follow oil prices and more importantly, the money supply. Now, having said that, so we were calling it stag deflation, and we were totally correct. And if you look at the last three inflation reports, they're really low. We actually now are just in stagnation, is what we are predicting. And that is that oil did run up. So that is a bit of an issue in the short run. Next couple of months, you're going to get a higher headline and a little bit of bleed through the core. So you might get a little more tariffs. So you might have a couple months of bad data, but the economy is weakening. So we think the Fed will still cut at least 2 times this year.
The clock's ticking on that because you have really July's the kind of the next opportunity that they could cut, and then August they have the summit in Jackson Hole, and then what? So are you thinking a cut in July and then another cut towards the end of the year, or are you thinking
I think they might delay
cuts
July because we're going to get this data may not be so good. So we in the short run, oil price is the best way to predict inflation.
Mm-hmm.
So there's 4 meetings left, so it might be in the last 2 meetings. Because they need to see probably more weakening of in the job market. And definitely is weakening. Mary Daly was just on CNBC, and she acknowledged that it's decelerating. The Fed chair did as well. It's decelerating, but not plummeting. I think they should pay more attention to continuing claims. They're 1.95 million. That's the highest they've been in recent history. And that's a leading indicator of employment. But this Fed, not, calling the Fed chair too late is very accurate. Actually, not the Fed chair, but the entire Fed, because they don't look at leading indicators like money supply, oil prices, claims. They wait for the actual employment data. So I don't think we're going to be in a significant recession, but they're playing with fire a little bit by waiting to cut. They could easily just cut once and then wait. It's really silly. It doesn't make any sense.
Yeah, there's a lot of speculation, and not to dive down the correctness of either aisle or whatever, but there is speculation that it's a political move, right? That they looked at this forward-looking data when it was favorable to a Joe Biden campaign, and now that Trump's in, they're saying, well, we're data dependent, so we want backwards-looking data, so we're not going to cut now. I'm not taking a side on that. Do you think that there is a component where the Fed has pivoted the way that they are looking at or considering the data, and that has changed? Or would you say the way that you viewed it, it's a lot more consistent than people give them credit for?
Well, I don't think this can't be proven, but I suspect that Janet Yellen prevailed on Powell to come up with the transitory theory of inflation so they could pass that gigantic $6 trillion spending bill. Because keep in mind that Manchin was holding it back because of inflation.
Mm-hmm.
So there might have been, and we'll never know unless we get the text between, Yellen and Chair Powell. But it seemed to me like I'm not going to use the word idiot, could have figured out inflation was going to 10% in the first quarter. I mean, of course, you might have to use some of our indicators, but money supply is up 75%. Oil prices are up 30. PPI was up 13. So it seems like either they're incredibly stupid or there was a little bit of political. And now it's not like they're out to get Trump, but keep in mind that given the state of universities, there aren't that many monetarists left. And also everybody's a Keynesian. And so Keynesians are the ones who are, so they don't care about the money supply. So they don't care it's shrinking, which they should. For some reason, they don't look at oil prices. They should. And they tend to focus too much on the labor market and this expectations theory. So I think now it's not political. It's just that maybe there's a little bit of political bias because they're like, oh, Trump's bad, so tariffs have to be bad. But that's certainly true in the public at large. But I think it's more just they have bad models that come from their Keynesian roots that are broken. And since they're so broken, they're not willing to take a stand. But our models all show we're going well below 2. And in fact, critical point on the macro side, inflation's already below 2 if you mark shelter to market. So shelter 6 months purposely delayed, more like 2 years because of using renewed rents that get renewed, not new rents. But if you look at national data, like apartment list, you're basically flat. So we publish a index that uses just real-time data. Like that's better. Who wants a silly survey that's delayed by 2 years? And that shows that PCE core is at 2 and CPI is only at 1.3. So this is another problem with the Fed is they use an index that's 2 years lagged. So in defense of them away from the political issues, in the first quarter of 2001, CPI wasn't showing a lot of inflation. Well, that's because it's 2 years lagged. The real big inflation was housing was up 20%, but CPI shelter was flat because they don't even update it they only update it every 6 months. So it's by definition behind. And then they use these panels that have renewing rents. So it's very sticky. It's meant to do that, I think, almost for political reasons because it used to be too volatile. But it makes the Fed, if they really slavishly follow it, always behind the curve. And so they do really deserve a lot of people don't deserve Trump's, labels, but they do deserve, and it's everyone, it's not just Powell, the too late moniker because they follow indices that are too late or 2 years behind.
Yeah. So do you think is your model or your macro viewpoint sustain more of you're using the word deflation, right? Is that more of a sustained thing or a shorter term thing because inflationary pressures creep back in, right? So if the Fed does drop rates, Congress passes spending bills, these sorts of things, like does that have then inflationary pressures that
Right.
maybe it's not back to major inflation, but it is back to the kind of standardized inflation target rather than deflation.
This is where the money supply comes in.
Okay.
It's critical. So right now, to keep Fed funds, and this is the master class to be fair, but to keep Fed funds where as high as it is now, because it's clearly high, the Fed has to shrink the money supply by 1% a year. To keep the price level flat, they need to grow it at 5 or 6. It's nominal GDP plus inflation. So like 3 plus 2, let's call it 5.
They have to grow the money supply at 5 or 6% a year.
Yeah. And we use the monetary base and we publish the global monetary base on our website if anybody wants to look that up. Because you shouldn't just look when it comes to interest rates, which are important to our products. We're going to talk about preferred stock later. But of course, interest rates are critical. So, but it's not just US monetary policy, although we're dominant, but Europe and other places are critical. But so the Fed, that's why I was saying earlier that the Fed could cut once and it would be totally innocuous because the money supply then maybe wouldn't shrink at 1, it would just be 0. But it's still deflationary because it's growing slower than nominal GDP. So the Fed can cut to somewhere between 2.75 and 3 and have 0 incremental inflation impacts. They'll just shut down the deflationary impact of tight monetary policy. So
and you're saying cut to 2.75 to 3% off the Fed funds rate from where it's currently at.
That was the level, so it'd be 150 basis points, somewhere around 150 basis points, because we're at 433. So that would take you
two and 3/4 or so.
Yeah, or 3. You can argue 3 that the SCP or the Fed's own projection says 3 is the terminal rate. Well, at 3, that doesn't cause inflation to be at 3. That's neutral on inflation because the money supply has to grow about 5 to get it down to 3. So that's why our methodology is far more usable than anybody else's, because everybody's just always using one side of the equation, like what's Fed funds at, but they don't look at what it takes for the Fed to keep it where it is, and that's how fast they grow the money supply. So, for instance, nobody knows this, but during the pandemic, they were buying so much securities, increasing the money supply so fast. They actually have to keep rates above 0. They had to actually offset that with short-term borrowing. And so the net increase in the Fed's balance sheet started to slow down because they were driving rates below zero. So to fully understand it, you can't just say, oh, rates are zero. You have to say, well, what does the Fed have to do to keep rates at zero? They didn't need to buy 1.4 trillion. That's what they were buying. They really needed to buy like 700 billion or something. But so you have to look at the Fed's balance sheet and look for that, what they're doing to create the Fed funds rate. So once you do that, then you are a master. So if you graduate from this master class, and you won't make these horrible macro mistakes like the Fed does. If you look back over the last 4 years when we've been publishing, we've been like ridiculously accurate in almost all of our forecasts. But it's not because we're geniuses. We use the right inputs. You got it. If you have a model with the wrong inputs, you're always going to have the wrong answer.
I have a saying about modeling, which is if your inputs are 99% accurate, your output is 100% inaccurate. That's why modeling saying it's always you know what I mean? There's always a range of possibilities coming out of the model, I mean, I still think I have like somewhat of an unanswered question, which is, so if the Fed funds rate comes down, and they start spending in Congress, like, does this deflationary environment that you're speaking of right now, does that stick around, or do we just go back to not inflation, but just kind of a leveled off environment, right? Like and the reason I ask is, right, like, let's talk about bonds for a second. Like they've gotten smoked. If you've been a bond investor the last couple of years, outside of maybe high yield, you've gotten smoked, right? Like it's been if you're a bond trader, there's been some awesome opportunity to trade bonds, and but largely they've been in this downtrend, right? And there's been some great, bond bear market rallies, if you will, particularly in the longer end of the curve where there's more duration. But if you start talking about deflation, that's the environment where people are like all of a sudden happy they own bonds, right? Or fixed income type investments. And so the question sort of becomes is like, so is it an environment where you want to be in on a trade in bonds, or do you want to now become just for sake of argument here or whatever, is like, do you want to be a bond investor, right? And I think the difference is timeline, right? And time horizon.
Well, we think you should be a bond investor. Now, it's easier and lower risk to do spread fixed income. So we have a preferred fund and yields like 9, or you can get high yield bonds that yield 7, 8. And then if you're a little bit wrong about the rates, you still get good long returns. So you're not making, if you just go buy a treasury, 30-year treasury, you're making a 100% rate bet. When you buy spread product, you're making a rate bet and a stock market bet, basically, or default risk, but it's correlated to the stock market. So certainly on treasuries, we think you can make a lot of money. Our target at the year end is 375. We're at 440. So that would be a pretty huge return.
375 on
the 10-year.
On the 10-year, okay.
Yeah. That'll only happen, if the Fed gets a little bit of religion, because everybody has to be confident that they're going to continue to cut. So we'll see whether they start to get religion that this tariffs, they're starting to, Mary Daly acknowledge a little bit today, but tariffs aren't significant for inflation, and the economy is weakening, and that I think will drive the bond market certainly to 4. Now, because the Fed's so far behind the curve, it might be next year before we get to 375, and we have a 350 to 4 range, so we're trying to be reasonable. But there is one non-consensus view related to the budget deficit. The first element that I think almost no one seems to understand is that the bill that's taking form in the Senate and House cuts the deficit relative to current law. It does not cut the deficit relative to assuming all the tax cuts from 2017 expire. Yeah, so doing nothing, just if they just renewed the exact same law that we had in effect this year and we have since 2017, that would increase the budget deficit by $4 trillion. they've cut about 1.5 trillion. So that's what you get, a $2.4 trillion number, but it is a $1.5 trillion cut. It's really 50 billion a year. This is all swamp math, right? So everything gets multiplied times 10. Like it's sort of like, we have hedge funds say, oh, well, we did, 150%. And people say, well, how did you do so high? Well, actually it's 15, but we multiplied times 10. So it seemed a lot bigger. So it's more ridiculous math, but so you use real numbers. They cut about 150 billion off the renewal, and then the tariffs are about 150 billion. So right now, I don't even think it necessarily incorporates all that. The budget deficit next year is expected to be 1.7 trillion. Might be a little lower if the tariffs kick in. So we're really not. I mean, we do have a problem in the long run because you have Social Security, Medicaid, and you have to bend that curve. But in the short run, probably have better growth next year. There's some level of conservatism in these bills, even though nobody wants to talk about that. And then the final point is just spending money by the government. In our models, that slows economic growth, but does not cause inflation. So savings equals investment. So when the budget deficit's bigger, there's less investment. So they cancel each other out. There's no more growth and there's no inflation. So inflation in our models does not come from government spending because we're not Keynesian. So they always think government spending jacks the economy. It only really works when there's slack in the economy, and we don't have slack now. So if there was a bigger budget deficit, that would be bad for economic growth because you get less investment and less growth, and growth comes from investment by companies. So we think that the budget deficit is most important for growth, and what really matters for inflation is the money supply and commodity shocks, which is really oil. So we don't look at the budget situation as being something that's negative for inflation.
So
and that is non-consensus, to be fair, but it's non-consensus, but you really kind of want to look at what we're saying because just look back the last 4 years, we've been almost always correct because other people tend to use these flawed Keynesian models.
So when the government prints money, so there's a big spending bill, they borrow from the Fed, and they bring that money into existence, adding to the deficit. You're saying that in and of itself is not an inflationary pressure under your model?
Well, it's a great question because Biden spent like $2 trillion on a bill that was kind of obvious we didn't need, and that did get monetized because the Fed was pegging rates at zero. So to keep it at zero, they had to put in a lot more money. But it's really a separate equation. Like the Treasury runs a budget deficit. They have to go borrow money. And then separately, the Fed doesn't give the money directly to the Treasury. They just simply buy the Treasury bonds that are outstanding or sell them. They've been selling them or letting them mature. So they're really two separate equations. But if the Fed chair was political and said, oh, wow, he's not, of course, not going to do this for Trump, but budget deficit is now 2.5 trillion, and I just want to jack growth. And so, we'll grow the money supply at like 10% a year to keep rates low. So as long as they don't do that, which there's no evidence they're going to do that, but there are situations, like I said, if it's fixed at absolute zero and you spend a ton more money, they do have to increase the money supply more. So there are certain situations where the Fed is just pegged rates at a certain rate, then that would, precipitate that. But they are two fundamentally separate operations. So it's important to look at them separately.
Okay. And, so like earlier you mentioned, like preferred securities. So just like as an asset class in general, you mentioned the way that they mechanically work a little bit, right? So if if you're looking at that, okay, this is your view, is that Fed's going to have to cut rate. We're in this deflationary environment. You typically want investments or most people would that yield in that environment, right? There's a yield to it or carry. but like preferred equities are a little bit different than bonds. What are some of the nuanced differences that people should be maybe like concerned about? Because you talked about like, hey, so if you get treasuries, it's just this direct play on interest rates, right? Because the coupons are so low on those from when they were issued. There's a ton of effective duration. And so if it takes 6 months to play out, you don't really get paid much along the way. And then if it goes against you, you really can get smoked, on the total return. But in preferreds, you have this heavier yield. But are they as interest rate sensitive? Are they sensitive to the market the same way? Do they have the same kind of, it's an equity. Do they have equity upside capture? Like what are some of the nuanced differences?
So that's the critical question. So taking one step back, we do recommend that most investors and of course advisors have a big income component for their clients, or even a small one if they're 20 years old, at least have a little bit. And then, so if you're looking at building income, fixed income is one way to do it. You can also do equity income. But with fixed income, without risk, there's no return. So the only two risks really are interest rate risk and stock market risk. Those are 99.9. You might throw a little bit of commodity risk in, but let's just stick with those two. So if you look at those sensitivities or betas, so treasuries, which you brought up, are going to be 100% correlated with interest rate risk and 0% correlated, or even normally negatively correlated with stock market risk. But right now, they're not over the last 2 years because in 22, everything went down together. But normally, you could say, like I've said this to my mother-in-law, like she gets really agitated about portfolio. She's a war baby, World War II. So I always say, well, you don't need to sell everything because of tariffs, because you already have 40% of your portfolio that's in very low risk bonds. So they're actually going up while the rest is going down. So treasuries give you negative S&P risk usually, and 100% correlation. All the other investment grade securities are pretty similar to that. So investment grade bonds, mortgages, munis, very high interest rate risk, not a lot of stock market risk. There's two asset classes that are not like that, but are fixed income. So high yield bonds, we all know, they are somewhat sensitive to stock market, about 0.3 and about 0.2% sensitive to interest rates. So preferreds are interesting in that they're 0.5% correlated to the stock market, or a beta of 0.5, and about 20% correlated to bonds. So that's why I mentioned it in that context, that with preferreds, let's say that I'm dead wrong about interest rates. We end the year at 440, but our target on the S&P is 6,600, which is not an aggressive target. It's 22 times 26 earnings, which are roughly 300. So 22 times 366. So we're bullish about the market. So if we're right about the stock market, but wrong about the bond market, preferreds almost certainly will be you'll get your income, but the price will be up 5 or 10% by the end of the year. If the market's up 10, well, it should be up 5. The beta is 0.5. So the price should be up 5%. If rates skyrocketed, there'd be a little bit of an offset. But if they just stabilize here, stock market's up 10, then preferred should go up 5. So it's an interesting hedge bet where even if you're a little bit wrong about the interest rates, you still get a good total return because they yield 8, 9, 10. And if you get a good stock market, you get tightening, and then you get another 5% or so on capital appreciation. So I think it's an interesting asset class. Should be really in not just preferreds, but also high yield bonds and everybody's fixed income portfolio, because it diversifies the fixed income portfolio. You take less interest rate risk and a little bit more stock market risk, but less than just owning Amazon or something.
Are you saying there's something else besides the Mag 7 to consider in portfolios?
Yes, like you were mentioning today, like our fund is up and everything else is down. So it's not bad to be diversified, particularly if you are getting close or even within 10 or 15 years of drawing from your funds, because you don't want to draw down. Like if you didn't have a lot of income, you might have had to take a big distribution out of your fund, in early April of this year. So you would have had to sell all these tech stocks. Whereas, like, I have my mother-in-law's portfolio. I only have one client. So I'm not compete with in your business, but and I don't recommend her as a client either. But she gets nervous. But her portfolio has about a yield of 4.5%. So she can make her RMD or her minimum distribution payment to herself out of income. So she doesn't have to sell like when the market's down. And that's what really should give investors comfort is they're not just making a big bet on the stock market. They're well covered, or at least partially covered by the income. So they don't have to sell the securities. And in the long run, the stock market's fantastic. It usually delivers 10% a year. And for a mechanical reason, which is they're retaining earnings, reinvesting. So I try to teach young investors, if you just buy a stock, hold it for 10 years, it's going to be up 160%. So don't play around with Bitcoin and, Palantir. Buy good stocks, trading at reasonable multiples, hold them for years. So, but you can, that works great. But if you're starting to draw it out, like if you're retired or need it for building a house, then it's way better to have some income securities that can cover some of your expenses.
A lot of people know me as an allocator. In my business, I do a lot of allocation for just retail clients. That's my primary business. And so we kind of putting my financial planner hat on, right? That perspective, I think to just translate what you're saying is yield is the item that can tighten the standard deviation around the volatility or sequence of returns risk, right? Particularly for those coming into or early in retirement, I think is the concept that you're trying to explain to people. And I think there's a lot of validity in that. So, but financial planners and advisors have a lot of different ways they go about accomplishing that for clients. But I think it all comes back down to the same principle, which is it can feel like the S&P 500 might be a savings account or something. But one of my favorite sayings I was taught, early in my career by another NAAIM member is, your largest drawdown is always ahead of you. And, whatever the historical max drawdown is, it's probably not the biggest it's ever going to be. Right. So I tend to look at it, Warren Buffett has said the similar thing, which is, if you're a stock investor, expect a 50% drawdown at some point, and if you can't handle a 50% drawdown, well, you shouldn't be owning stocks probably. And I think just to add to Warren's, old Uncle Warren's thought track is maybe you shouldn't have as many stocks, right? And you should time that to the same effect. I think we lost Jay. Anyways, so for those still listening, I think the idea is to always position size what you're investing in, and that's how as professionals we can help our clients in a really dramatic way. So appreciate you guys all listening in today. Tune in next Friday. We should have another great episode. And if you ever have any questions, comments, or guests that you would like to see us bring on to the show, go ahead, reach out to us. You can always get a hold of us. Find us at NAAIM.org. And as a quick reminder, we do have our conference coming up. It feels a little far off, but it will sneak up on us in early November in Chicago, the Outlook conference, named Outlook. One of my favorite conferences of the year. So highly recommend you guys check that out. And we will see you guys